Good morning, morning good after a few many months. United Kingdom, and good morning. We have the famous, the infamous, the mover, the grower, a man with many talents. Recently attended, I think you organized, isn't it, the black tie event in London?
Yeah, part of the organization team.
Yeah. So, one of the sort of like the edge of the sword, I would say, in the city of London, a gentleman who is ahead of the game, ahead of the curve. I think one of the first organizers of events to take place in 2021. Is that right, Lakhi?
Well, yes, one of the larger events. 500 people attended, so we had a pretty good turnout, that's for sure.
So where did you? Was it some intuitive thinking on your committee side, or is it something that just was pre-planned?
I think more of intuitive thinking from Linda Johal, who is the main organizer of the event, because I think he saw an opportunity to at least open his doors for the Signature Awards and open up in London. He's already got quite a big following in Wolverhampton, I think Leicester and Birmingham, and he's looking to have wanting to open up in London because of COVID-19. Everything got held back, so he's just pushed it this side of the year, so he could take somewhat an advantage of people's pent-up requirements to probably get out and network again and do business again.
Okay, and that goes on to the topic, trying to do business again. I think we were having a discussion just before we started, really. Lakhi Singh and I were having a bit of a discussion about equity release, and obviously I'm not that familiar with it, but I was taking an input from Lakhi to find out where equity release comes into the game, and it is about an easy route to money, but it's got certain conditions on it. Now, a lot of people we've got come to us. Lakhi deals with lots of the large family offices, 10 million plus. I deal with smaller clients, but all of them are looking for cash. Is that right, Lakhi? Everyone's looking for money. Is that right?
On the whole, yeah, people are looking for some sort of debt funding or equity funding.
Yeah. So what are you going to say that how does your equity release fall into this? Because remember, we are primary in the commercial unregulated market. We don't touch regulated stuff. That's what you say, Lakhi. But why is the topic sort of steering towards something which is regulated? Why are you going to say, are we talking about it? Well, the reason we put this topic down is equity release is an easy, short entry into releasing money from your property and using that money to effectively pay off bills, any debts, even use for business, even until the extent of paying out your children, their inheritance money, etc., etc. And it's an excellent way of getting money. But there is a big if in this matter. The if revolves around credit file. And as we know, most things in the market all need someone to have a clean credit file. Now, I think one of the major stumbling blocks you have, Lakhi, when you're doing commercial lending is that you may see some quality in a project, or you may see some angle on a deal, but the people who are coming to you for money, one of the shortfalls, one of the stumbling blocks in most or all of them is their credit worthiness. Is that correct, Lakhi?
That's 100% correct. Yeah. So I think it's can't really release money unless you've got very good credit, and credit can only be so you can only get good credit by keeping up with all your records and making sure your credit cards are paid in time. There's no arrears, no defaults, no CCJs, etc., no court judgments, etc.
Yes. So credit file is the biggest stimulus. So therefore, what is the alternative? Then goes into the commercial zone, because in the regulated market, if your credit is no good for equity release, it's not going to be good for anything, is it, Lakhi Singh? Is that right?
That's correct. Yeah.
So now you're going to get pushed into commercial lending. Is that right? And with commercial lending, what are the benefits, Lakhi? I mean, a lot of people don't know about cash flow bridging, or bridging money quickly, or how to get access to quick money by releasing equity from their property on a commercial capacity. And there's certain limitations on that, isn't there? Like, there's certain easements on it. So you can tell us first what those restrictions are on equity from unregulated lending.
Okay, so if you can't get, you need money, there are lots of alternative ways of getting funding if you can't get it from a regulated lender. So you can get access to personal loans or business loans. You can get first charge loans on assets you've got money in, but you haven't got good credit. And you can also get second charge loans on your house if you're putting the money into a business. So there is a lot of commercial unregulated lending that you can pull into the equation. And you can actually get the funding, believe it or not, pretty cheap, even if you've got bad credit. There are a lot of adverse lenders out there that cater for this market.
Excellent. And I assume one of the main purposes of raising money, especially after the lockdown, is debt settlement. Is that right, Lakhi?
Yeah, I think debt settlement also is an area where you can consolidate your debts and come up with a payment plan with lenders. Although it does actually bring your credit rating down, there are quite a lot of debt settlement type solutions out there. So if anybody needs assistance in any of these areas, we've got whole swathes of different types of teams that can help in different areas of debt and raising money.
Okay. So can you tell, I mean, for the all of us, we're not quite clear on certain of these points. What is debt settlement in terms of standard property portfolio? A landlord who's got properties, got assets, and why would you want to first settle the debt? Hasn't he got a mortgage on it, or is the mortgage now? Well, what are the reasons somebody wants to settle the debt?
A lot of people have basically taken on 100,000, 50,000 on credit cards to buy properties, and on the odd occasion when they've needed money to buy an asset, they've also dipped into their credit card and actually max their credit cards up, and they're paying extortionate rates of maybe 20%, 30%, 40% a year, even up to 50% with certain credit cards. And they then need to consolidate their debts and reduce down the amount of borrowing they have. Otherwise, what's happening is the amount of profit they trying to obtain from what they've invested into is far lower than the amount of money they're paying out on their credit cards. So quite simply, they have to, well, you have to really consider all these type of issues and do let's just say, a detailed breakdown of the costs and the profits, and look at how best to reconfigure and consolidate all your debts.
Okay, what you're saying is right. Okay, you're settling the debt, but are you saying debt settlement entails writing off or writing down or completely extinguishing a debt? But don't you raise another debt somewhere else to extinguish that debt? And why would you want to need to do that? What's the reason you normally have to do debt settlement of one thing from raising finance from another? What's the hard and fast rule? What's the right way of doing it?
Well, obviously, if you can get cheaper lending against your assets at 5 or 10%, but you're borrowing money on a credit card at 30, 40%, it's a lot more viable to be using your assets to borrow against things.
Okay.
But
What you're saying is the service amount on that amount reduces if you settle debt with a lender that's giving you better terms of lending, so that you take 100,000 from one lender who's giving you a better interest rate to pay off another 100,000 that's higher and more expensive to service. Is that right?
that's right. I mean, there's a caveat to that point, which is that a lot of people, when they're starting off, they've got very little access to liquidity or cash. So what they tend to do is they tend to borrow money at the cheapest rate, and there are a lot of 0% credit cards. I know people to take up to 50 or 80,000 pounds on 0% credit cards to do their first 2 or 3 property deals. And the only problem is that you're having to juggle those credit cards over a number of years, and it's only a matter of time before the credit card debt sort of catches up with you, because you can't really infinitely continue with that way of actually borrowing money. So whilst it could be a good way of actually getting into the market, it's not necessarily an easy thing to get out of once you've gone down that route. So I'd suggest having assets in the first place, or having access to some form of asset that you can borrow against in the first place would probably make it a lot easier, obviously.
Excellent. Okay. So if we take the understanding that using your credit card is wrong, not because it's not convenient, it's just that it costs more to use that money, then the principle is you go down the route of debt settlement when you know that you can effectively reduce the amount of outgoing. That's one of the reasons, I assume, you are going to be looking to settle debt, even if they are premature or being moved from one company to another. Is that right, Lakhi?
Yeah, I mean, having a conversation with a business colleague a couple of days ago about this, which is that if you haven't settled your debts, then it's number one, if you're running a company and then you're looking to borrow money into the company or have money introduced into the company from investors, for example, if you've got any form of debt or some sort of court hearing against your organization where you owe money to a credit card or to an investor or anybody, then, and if it's not paid off, it actually sits on your credit report and on the company. So anybody wanting to invest into your company, they're going to be thinking, okay, well, is this a reputable company? I'm going to invest £500,000, but just got £10,000 second charge on or still got £10,000 showing as a payment that's not been made. So I think that's quite a good reason to be actually clearing debts, which is to just show that you're a viable business. That's one reason, or a viable individual when it comes to investment as well. So there's quite a few different nuances in relation to debt that people have to consider.
Okay, so let's move on from that then, Lakhi. That you obviously need a good credit file. You need to be clear about your commitment to the debt. Are there any other circumstances where people are looking to, especially after COVID, have you found a commonality of people wanting to come and settle debts? On what type of area is it? Like individual, like you said, credit card debts, or is it, business debts? Is it, I don't know. What's the pattern of debt settlement?
Well, there's quite a few different settlements. One major one that we come across as an organization is something called shortfall debt, where a bank's taken a property, they've sold it, and there's a shortfall of a negative equity property where the bank sold it, and there's a amount owing that they can't pay from that property. So that's quite a dangerous one, because if you don't pay that, the bank can technically put a charge on your house, and you will then have to, you'll be in a position where you've got debt sitting on your house, which is obviously not good. So you're better to somehow negotiate that debt, or talk to us and we'll negotiate for you the negative equity debt with the bank. So that's one form. That's the other areas are where people have borrowed on credit cards and they need to borrow cheaper money against their personal house or their business and pay off their debts. But a lot of people also have equity sitting in their properties, and if there's a falling market, as what's about to happen will be around the corner now, a lot of people want to take money from their assets, refinance, and get cheaper borrowing and have access to more liquidity to buy assets. But if they get a good deal, they may not want to get a buy-to-let mortgage. They may just want to take a second charge or a business loan. So there are lots of different options out there. So those are the sort of key ones anyway.
Okay, I want to go back to the first one, because that sounded very eerie, really. When you're talking about negative equity, what is that? Where does it come from? And what has that got to do with debt? Well, how do you settle debt when you've got negative equity? I mean, surely negative equity would have come from somewhere, from the transaction. Who's in control of the transaction? And if someone else is in control, why is it that you're having to pay the negative equity? How does that work?
So the way negative equity works is if you've broken the terms and conditions of your property, for example, you've gone into arrears, and the bank has the ability to appoint something called use the Law of Property Act 1925 to appoint receivers to collect rent and have the power of sale. So if the bank decides they want to sell your property, they're quite at liberty to do so. So once they sell it, if the debt, say, is 200,000, the value of the property is 150,000, they end up normally selling it for about 100,000 actually, because they just want to alleviate the asset, or get rid of the assets of their books as soon as possible. So you could be in a shortfall of 100,000. So that's how this particular debt is derived. Now, once they've sold the property, that £100,000 debt is short in their terms, but they're in a position, the bank's in a position then to basically come after you to put a charge on any of your personal assets, your business assets, to get that money back from you. And I think that's quite a dangerous place to be in, because you could actually be losing out. And if you don't have any assets, then but you do have a good income, they have also the ability to go to court and put an order on your wages. So I can't remember the name of this particular order, but the order allows them to collect money from your monthly wages as a deduction to pay against the shortfall as well. So it's an extremely tough situation to be in. And a lot of these situations, the clients that we get, they would typically go bankrupt, or they may go into an IVA to try and negotiate the debt. So there's a lot of things to consider actually in these type of circumstances. So just to sort of, I think Vijay Sal's got a important call coming through, just to reiterate a couple of other points. And so my understanding of equity release itself is, as Vijay Sal said earlier, you've got something called regulated equity release, which is a technical term for somebody who's a little bit older, they've got a house, but they may need care, or they need assistance, but they don't have access to funds because they've got a smaller pension. So they can release equity from their house, and they can actually get money from their house. In some ways, the older they are, the more they can borrow, and at a cheaper rate. But the younger they are, the more expensive the borrowing, and the less the money they can take out, is the general rule of thumb. But the whole idea of today's topic is not equity release for somebody who's elderly and looking to release funds. The equity release I think we're talking about today is ability to access cash, access funds, to be able to consolidate or grow your assets. The question is, how easy is it to use certain tools, and what's the best way of actually getting money to be able to consolidate your debts or actually grow your portfolio?
Excellent. Okay. So what you're saying is, you've got a situation where debt in this market now, after COVID, where do you see the majority of the debt issue coming from then? Is it, okay, one of the questions that came up, you explained negative debt. If the bank is selling their property, why is it negative then? Is the property no longer worth the same amount, or is it just because the bank doesn't care? If the borrower is selling it, will it be negative debt as well?
So just read the question again, just missed it because I've got a couple of texts come through.
Okay, if the bank is selling with and creating negative debt because they don't care, well, does that mean if the borrower was selling it, they wouldn't have negative debt and they would be able to sell it at the right price? So why would the bank want to put the borrower in unnecessary stress that way? It sounds a bit convoluted, drastic.
Okay, so the critical word key words that come to mind is something called debt provisioning that come to mind, which is the reason where the bank is completely aloof, let's say, is a strong word, aloof, or doesn't care. The slightly emotive words are from the bank is because they tend to win whichever way things go. But for them, it's all about the numbers and their accounting procedures for their organization. And large corporations, banks have certain things they've got to fulfill for their shareholders, for their board of directors. And due to that type of work and the way they're structured, they're in a position where they don't have to worry about what happens to you, Mr. Consumer. Their situation is that long as they tick their boxes for their main stakeholders or their critical stakeholders, which are their directors, their shareholders, they frankly wouldn't care. And that's one point. The second point is that the debt provisioning means something called double accounting, where they are insured against the losses that they're going to incur from the sale of your assets already. So they don't lose either way. So if your asset's worth, let's say, for argument's sake, 500,000, and the debt on your asset was, let's just say, 600,000, and you're negative equity by 100,000, they're quite at liberty to sell the asset for 400,000 and still claim back the 200,000 pounds that technically you would think they've lost, but reality is that because they're insured against it, they're going to make that money. So that's one way which they benefit. The other way they benefit is obviously they put pressure on the individual and go after them and their other assets, then they can reclaim that 200,000 pounds again by putting a charge on the house or putting a payment planning together by doing an earning attachments order. I think that's what it's called. So they've got multiple ways of actually getting money back out from the consumer, as well as covering their back through debt provisioning.
Okay, so can an individual do this debt provisioning thing you're talking about?
No, that's not possible. It's only available to the powers that be, because they are.
What about insurance then? What about insurance? Can an individual to debt settle, to settle the debt? Can't you insure? Can't you take an insurance policy out that will settle your debt?
No, not as far as I know. I haven't seen anything like that. So the only thing the consumer can do.
There's definitely an area.
I think you seem to have got cut off, but can you hear me okay?
I can hear you.
Okay. So I think you were about to say, I think I didn't hear any of that.
I said that means there must be a gap in the market where insurance companies could probably offer to the mortgagors policy to protect the debt or the negative debt. Isn't that the clever way to do it then?
I'm sure there must be a way, but I don't really know. But I haven't heard of anything like that. So the only thing the consumer in these circumstances can do is to avoid getting into a situation where they're between a rock and a hard place. And the only way to do that, number one, is to have read the terms and conditions of whatever contracts they've signed on their buy-to-let mortgage, to make sure that they've understood what the implications are for non-payment. And the other way is, obviously, if they've gone into arrears, there are solutions to disinstructing the receivers that take on the property. There are solutions by way of bridging finance. There are solutions as a way to actually structure a sale in a way that allows you to still not be in a position where the property is sold under market value. So all those three potential solutions can only be applied once you've spoken to a specialist, I'd say, like ourselves, where we have the ability to do an audit and check really under what circumstances what could be done to facilitate you getting out of that position. That's pretty. It's a huge quagmire of complex legal, finance, and sales type issues. And if you haven't got like a comprehensive understanding of them already, then you could end up actually getting yourself thrown in from the fire pan into the fire type situation. So I suppose having that type of knowledge and working in this industry in property for 30 years now with our teams, we're able to decipher really which would be the best way of actually dealing with this particular problem. It is a big problem. It's never really addressed or talked about. It's swept under the carpet by the banks and by a lot of property companies, because they want to talk about the good stuff. They don't want to talk about the problems that you can get when you're buying property.
Okay, right. Okay, I'm going to have to excuse myself. What's the time now? Okay, Lakhi, I'm going to beg leave. Would I trust you to continue and take over for the remainder 25?
That's fine, I can do that. Right, guys. Yeah, this is Lakhi Singh, the property fixer. Thank you very much, Vijay Sal, for the introduction to the topic of equity release. So thank you very much for your time and
Thank you very much, sir.
Giving us your inputs on
Thank
equity
you very
release.
much. I'm going to leave you to continue with. So the main, obviously, the thrust of today's topic is around debt settlement. And then obviously these are the ancillary things, the way to settle the debt. And equity release happens to be one clever, easier way, less commercial, less expensive. But, I think the most important thing that revolves around it is your credit file. You must have a good credit file if you're looking to do equity release, especially in this market after lockdown. Okay, Lakhi Singh, I will leave you I'll leave the audience in your safe hands, and I will speak to you later. Take care.
Thank you very much, Vijay Sal. Okay. You're flying in and giving us your assistance in hosting today's show. Now back to Lakhi Singh, the property fixer. I'm hosting now. So thank you again very much for the inputs there. So I'm going to try and break down some of these topics now regarding finding finance. Now, a lot of people, I had maybe about 5, maybe 10 key things I think that could be really useful for a lot of viewers out there to know about equity release. Number one, we are in a falling market at the moment, and I think it's very important to consider certain factors about if the property market is falling, then there's two or three key questions come to mind. Number one, are you in a position where you're looking to start in the market? Are you already semi-established and you want to now grow? Or are you quite established already and you're looking now to take it to the next step, scale up to become a multi-million-dollar or pound corporation? So those three questions come to mind now. In all those three circumstances, there's particular things you need to do. So if you're just starting off, then I think the first thing that a lot of people ask me is, well, equity release doesn't apply to me. But technically it does, because you may have a friend, a business colleague, or family that want to support you in your journey. And if they can release equity or finance property with you, you've got a trusted relationship. You can set up contracts or agreements with them, which allow you to potentially grow your portfolio or start your portfolio at least by having access to people with good credit. Let's say if you've got bad credit and you can't access any funds because you've got no assets. So you could work with somebody who's got access to funds and clean credit. So you could actually do joint ventures where you bring the assets and they put the money in and you make a margin. That's quite a good way of starting off, and using refinancing as a tool to allow them to profit and for you to make a margin on every time they profit. So I have worked on projects where somebody sourced a very good deal, the investors put the money in. So the investor would either do the funding on a investment and return basis, or they would the investor would invest and then they could do a 50-50 split on profits after all costs. So a lot of that just comes down to the detail. Second type situation is where you've got somebody who's got 5 or 10 properties. Now they may find that some of the properties they got, 1 or 2 maybe in negative equity. So they may want to consolidate. So they could actually refinance out 1 or 2 of the other properties with equity in them to pay down the negative equity properties and restructure the whole portfolio. And the other critical point that comes to mind now is that you may want to consider putting your property portfolio into a 2-year, 3-year, or a 5-year fixed rate, because if interest rates do go up, then you don't want to be in a situation where you can't determine how much money is going to be going in and out every month. And if the payments going out are at a very high interest rate because you're on a variable rate, then that could be very dangerous for you. So you have to be extremely, extremely cautious, I would say, and just making sure that you are in a position where you can actually think about, you need to think about really whether it's worth you going on a fixed rate. Obviously, if you've got 10 unencumbered properties, 1 property that's on a variable rate, it may not be such a big deal. But whereas if you're quite highly geared, 75% loan to value on a £1 million portfolio, if interest rates went up even a couple of percent, if you could be a break even or negative cash flow. So I think you've got to consider all these sort of potential scenarios and assess the risk very carefully now going forward, especially in the next 4 or 5 years, because the property market is very volatile, and you do have to think about all the scenarios out there in terms of what could happen. So that's scenario number 2. Scenario number 3 is you've got somebody who's got quite a large portfolio. It's quite lowly geared. So I think this is a good time to start thinking about how to put some funding lines in place, especially if you've got a portfolio with very little debt on it. So there will be lots of buying opportunities out there to buy land with planning, to buy assets which can be refurbished. Not only that, you could also buy assets which have got a good yield, like an HMO or serviced accommodation, and actually up the yield on some of these assets. So all those formulas, land to get enhanced planning, getting a block and refurbishing, and then getting assets which you can own and operate and get a higher yield on through rent to rent, through service accommodation. So all these options available for you. And if you're finding that there's lots of buying opportunities out there in the next 6 months to a year because the market's going to tighten, then it's a very good time now to put a lot of your properties, again, this goes back to somebody who's in the mid-tier position who's got a few properties. Also applies to somebody who's got a lot of properties. If you've got certain properties which are slightly highly geared, is to probably bring them into control by putting them under fixed rates. At least you know what your payments are and whether they're affordable. And that might be a more viable, a better solution for you than to be in any other position. So there we have it. I think that's quite comprehensive in the type of things you should be doing or considering going forward in those 2 or 3 scenarios. Now, a lot of people ask me, okay, should I be in a fixed rate or should I not be in a fixed rate? And it all comes down to really the level of risk that you're going to be putting yourself under. And on the whole, I would advise not to take too much risk, or reduce the risk down to 0 if you can, because whatever happens in the market, volatile as it may be, then you've covered all the angles and you could sleep easy. Why would you want to create this extra stress when it's unnecessary? So those are the sort of 2 or 3 scenarios based upon what you could be doing to be able to get funds or release funds. Now, a lot of people do come to us, and they come up with more complex situations. So let's just say a client comes to us with a shortfall property where the bank's taken it over, sold it, and there's £50,000 now owing to the bank because they've sold it below the debt amount. And now they're saying they want to put a charge on your house or they're going to take you to court. So these sort of situations require more of a detailed analysis by our immediate bank claims department. Immediate bank claims is an organization that specializes in stopping repossession in 24 hours. So it basically has access to expertise with 200 solicitors that can attend court anywhere in the country, normally within 24 to 48 hours to stop a repossession. So we have those skills to be able to assess your whole situation. Now, in this negative equity shortfall scenario, it's we would require, number one, all the paperwork leading up to the shortfall. Also the shortfall paperwork, also the details of the bank. And what you would also need to know is what your current state of affairs is with your current property portfolio, or if you do actually have any assets at the moment. So that will help us to then look at what you can and can't do to allow yourself to get out of this particular pickle. And I'm not going to get into the detail of what you actually do for the moment, because we'll need to do a detailed audit of really what your situation is. And the big question people ask us is, how much will it cost? Well, to understand your situation and work out what you need to do, there's nothing to pay, because we're going to go through all your information and look at really what is the best way to deal with it. But that half an hour consultation is for free, and we'll tell you potentially what we might charge, or whether we're willing to take on the case, whether you've got a chance of succeeding. But most of what we do will depend upon the detail of the information you provide us. The more detail you provide us, the chronology in terms of times, dates, what happened, verbal conversations, written conversations, all of that in a neat, tidy document would allow us probably the most chance to be able to understand really what your chances of succeeding are in terms of fighting a bank who's chasing you for a shortfall. So quite a lot of information to take on there. What other scenarios are there where you may want to raise finance? So raising finance is quite easy. It's not difficult to raise finance. It's actually finding the best product, the best solution to your personal circumstances, understanding, how long we want the money for, what the purpose is. So all these things we would audit, and we would have a panel of lenders for every scenario pretty much. So I have pretty much a panel of lenders at every level, from a small 50,000 pound property going up to 100 or £1 billion type assets. So we cover the very small to the very large complex type assets as well. So we've got the ability to deal across the board. So then the other side is we get people in very, let's just say, bad adverse type situations where they've got CCJ, they've got missed payments, they've been made bankrupt before, they're finding it difficult to get a bank account, they've got credit card debt issues. So that's one extreme. So we have the ability to access adverse lenders who can still lend money even under those circumstances. So we have access to funding lines in both scenarios, or all scenarios, adverse. Then on the other extreme, we work with clients who've got very good credit, got a mass of property with very low gearing, and they're very, very rate sensitive, because they're so we've managed to get a client 1% interest rate on a 100 million pound asset with a 50% gearing in London, which is incredible, isn't it, if you think about it, on 50 million. So we can deal with one extreme to the other, and we also have a middle ground. So there's people who have maybe clean credit file, but they may have had bankruptcy in the past and maybe missed one payment, and so they've got their credit rating is a tiny bit skewed, and they're not quite sure about what they can and can't do. So that's a sort of middle ground position. So we have the ability to find the right lender to meet your particular requirement depending on your set of circumstances. So we can cover not only very complex, difficult position, we can also cover very simple, client is very interest rate sensitive. We can cover both spectrums. So it allows you to actually get to where you want to go to quite easily. So there's quite a lot of information there. So if there's any questions from anybody out there, then do come back to me. I've got a few people saying hello. So hi to Hazel, hi to John, hi to Raj as well. We got Michelle. I haven't got my glasses on, but let me just check. Hold on 1 second. What does it say? Michelle Uricourt, I think. She's saying good morning. We've got John Smith saying good morning, both of you. And we've also got Sati Gill, and we've got Gurvinder as well. Wow, quite a lot of people saying good morning this morning, which is nice. Hope you all had a great weekend. I'm also going to go back to the quote of the week now. So just give me 1 second. So, okay, 1 second. The quote of the week is, no matter what people tell you, your ideas can still change the world, is what I've made out of it. So are you in a position where you have ideas that can change the world? We also got Danny Antank here saying good morning. Good morning, Danny. How you doing? Hope you're well. So yeah, so let me just repeat it again to you 1 second. I've got it here. No matter what people tell you, ideas can change the world. So no matter what people tell you, ideas can change the world. So basically what I understand that to mean is that if you've got an idea, I think I can just about read what Danny's written. It's saying, still changing the world, fella. That's right, still changing the world, at least attempting to. So question is, if you have an idea, are you the type of person to take action to make the idea happen? Or are you the type of person that's gonna basically sit on your laurels and wait for things to happen? So if you have an idea, no matter what, I think you can actually make a difference in terms of making things happen. So a lot of it is actually about your mindset. So either the world decides what you do and you follow suit, or you have an idea, you realize its potential, and you make it happen. So that's quite an interesting topic actually to discuss. So any comments from any of the viewers out there would be really appreciated in terms of what do you think? Okay, so to round off today's discussions, we've got another 5 minutes. I'm gonna do a quick summary for you. I'm gonna try and reel it all off in a simple summary. So we are in a position now where the market's changing. There are a lot of opportunities we're going to have abundance of opportunities in the property market. So we're in a position now where a lot of unprecedented things have happened in the last 2 years with COVID-19, with Brexit, with all manner of other issues around furloughing, stamp duty holiday. So are you thinking out the box? Are you able to think of ideas now to try and do something different where you can make money in this market? So number one, I would say to you, if you've got any type of debt issues, you probably want to make sure you get your assets cleared up and get them tidied up and consolidated. Now, consolidation is quite a complex word for some. People don't even understand really practically what it means. People say, let's consolidate. But consolidate actually means to develop an approach to stop doing what you're doing and just look at what you do have and actually simplify all those things into getting them structured in a way that you're more efficient. So stop, audit, and then streamline. So stop, audit, and streamline is what I would say consolidation means. So that's one of the first things I think a lot of people need to start doing now, especially if they want to start taking advantage of the current market space. I think we're going to have a huge glitch in the property market, a potential fall. In that fall, there's an opportunity for people that are prepared. So plan, prepare to plan, and your preparation will probably give you a huge benefit because you can get a huge return on your preparation. Because when assets do fall in price, if you've got the right strategy in place, you could be picking up assets at a very good price, or picking up particular types of deals in business which are going to suit your profile. So the first thing you need to do is really look at the potential of actually consolidating all your debts. So debt settlement is critical. The second thing you need to do is to possibly reduce your exposure or risk by going into fixed rates where possible. The problem with fixed rates is that they only last for 2 to 3 years or 5 years, and you have to refinance again, which is a lot of hassle. So that's number 2. Number 3 is that if you've got credit cards you want to consolidate and reduce the debt down or pay it off or come up. Ideally, what you want to do is with credit cards, you want to negotiate the debt out. Ideally, if you can do it for 5p in the pound or 10p in the pound, so your debt is 10,000, you can negotiate with the companies to pay them £500 or £1,000, they'll take it. So there are ways of actually consolidating your debt down altogether. That will actually then help you repair your credit report. Then in turn, once you've got a clean credit report, you can go out there and then you can find it'll be easier to refinance any assets, have access to cheap money from refinance of assets because you've got a clean credit report. If you can't get a clean credit report quick enough, but you've got good opportunities coming up, then you just got to make sure that you've got a very effective spreadsheet that does all the breakdown of the assets you're purchasing. The analysis is critical to your success. So if you've got the right spreadsheet analysis, the right coaches and mentors, I'm sure you'll find the right deal. So I'm going to leave it at that. There's a lot of information to take in 1 hour. Even my head is spinning after that. So I hope that's been useful for you all, you guys. Equity release, finance. I think it's going to be a critical part of your success for 2022. So start prepping now, get your finance sorted. And Lakhi Singh, the property fixer, is here to help. Hope you have a great week, and we'll catch up very soon. Goodbye from him, and it's a goodbye from me, Lakhi Singh, the property fixer.